Hey everyone, it's Imran from Options Insight, your macro options daily. So stocks remaining pretty heavy, but at least they weren't accelerating lower. This 3,900 level on S&P seems to be the next key sort of support region ahead of OPEX next week. That's kind of what the various gamma models and stuff out there are kind of looking at and saying that if we were to break 3,900 to the downside, then that would probably open up a load more volatility. But whilst we stay above that, we have the potential to kind of stay, markets have the potential to kind of rally from here probably. Now in commodities, we did see a decent bounce on the metals. We see silver, gold, etc. higher, also copper, and then even natural gas having a really decent rally, 8%. It was coming from very oversold levels though, so it was due a bounce. Oil still remained under pressure. Was down about 3% on the day yesterday, but it is putting in about the 3% bounce right now. So oil finally finding a bit of a bid, but it has been pretty weak lately and it has been breaking below some quite important levels. If we look at vols, we see vols continuing to drift higher. So you see around about half a vol point across US and European indices. VIX on the other hand, VIX vols getting slammed, 6 vols. As the VIX level kind of back to that 23 area on VIX spot. And, people, because we didn't get that acceleration down yet, the VIX level itself isn't moving that much. So therefore, straddles on VIX are kind of coming under pressure. Now, we do probably need to break that 3,900 level on S&P to really see vol pop. And then I'd probably expect to see some VIX buying come back and maybe some VIX vol buying as well. Commodity vols, on the other hand, generally better bid. You're seeing 1 to 2 vols across the board, other than copper and gold, which were like a bit more benign. Generally, commodity vols seeing some bids. Nat gas vol, obviously, at around 95. It has come down considerably from the highs, which are closer to 120. But that vol's still at around 100. But it is realizing a bit better recently, right? It's realizing 86 right now. Realized was down to around 60. So at 60, you had a lot of juice. Whereas in this carry, you can see we're only at 12% now. So no longer the no-brainer carry earner that it was a few weeks ago. And actually, you're getting better carry out of the likes of oil, which is up at 27% here. And then speaking of carry, we're seeing a lot of carry in European indices where they're still just realizing single digits. And we're also seeing decent carry out of Asian indices as well. Where I wouldn't be selling gamma would be US index. Even though it's popped, a good 2 vol points on the week, you see implied to higher, but they're more in line with realized. And we know there's those major catalysts coming up next week in terms of CPI and FOMC. So I would not be shorting things like S&P or NASDAQ gamma ahead of those catalysts. In terms of skew, we saw Russell skew get hit for whatever reason. That's starting to look quite cheap on a relative basis. FTSE skew and DAX skew are looking relatively expensive there. And if we look over at commodities, we see that metal skew in general has been offered as we are starting to see much more bullish price action coming out of the metals. And we've got negative skew in silver, negative skew in gold. So people paying up for the calls on a relative basis there. Okay, looking at the other asset classes, dollar struggling to make any headway, even as risk assets remain relatively weak. It seems like the idea of a US recession is not being well received by the greenback right now. The dollar smile framework that people talk about kind of requires a global slowdown. And if we were to get a US slowdown and China reopening at the same time, then that's probably not great for the dollar, basically, right? So that's really the thing that is kind of putting the dollar at risk of a significant material sell-off, even in the face of a US recession. Whereas normally in a recession, if the US is in recession, everyone's in recession, and the dollar actually does relatively well. If we look at bonds are absolutely on fire. TLT now getting close to 110. It's kind of the most ridiculous 10% rally in bonds, or fastest rally in bonds that we've seen in forever. So you can see the Sigma move on the week was like over 2 Sigma, 6.5% on the week. Unsurprisingly, volatility catching a bid. So TLT vols are back to 22, even in the face of a rally. And you can see skew on TLT, therefore getting slammed. So TLT skew at -1.5 now, which is the 1 percentile. And that is, pretty extreme right now. So clearly people panicking a bit now, thinking, God, these bonds are just going to keep rallying to the moon, right? So generally when that happens, it looks like a short-term fade. So if you haven't already got hedges on in TLT, I've already got my hedges in place. So that's fine. I don't need to do anything. But if you haven't already got hedges on, these are great opportunities to put bearish risk reversals or call overriding strategies on a long position that you might hold in bonds. This is a nice entry point for those sort of trades, given how much of a rally it's had and where the skew and the volatility is lining up right now. Okay, outside of that, what else are we seeing? We're seeing HYG having a little bit of a rally as well in sympathy with the rates move, but we do like selling HYG, fading rallies on that, although the vol has popped a bit recently. And then looking across at the other vols, sector vols catching a bid in general. You've seen ARC vols up decently, about 4 vols on the week, as are XLE. We'll talk a bit about XLE in our trade ideas, but that vol has caught a bit of a bid and isn't carrying very well. You can see in terms of carry, we've got positive carry coming out of XLE and XLF, saying that those things aren't really realizing as much as their implieds would want them to. Okay, that's it for the summary. Now, in terms of what I'm seeing out there, really the big thing is China. So I'm starting to see China really shifting the COVID narrative, right? So obviously everyone going after the China reopening story, will they, won't they, back and forth. But we've definitely seen since the protest a couple of weeks ago, that they seem to be responding quite positively, right? So they need to change, rather than accepting, oh yeah, we're going to do what you're saying to the people. They're going to obviously change the narrative and make it look like it's their decision, even if the real reason is they don't want to load more mass protests, right? So in response, what we've seen, they basically got the People's Daily state-sponsored publication, which we'll call it the propaganda machine. They've had no mentions of dynamic COVID-0. So if you look at like how often they talk about that over the course of the year, and the fact they've not mentioned it once is quite an interesting sort of change, right? So December, they're kind of dropping that whole wording around dynamic COVID-0. They're also in general talking about how the virus is less deadly now. So they've kind of won the battle against the deadly version of the virus. And now that they've won the battle with this great policy that they've had, they can now change course. You also look at the case count data from mainland China, see how it's peaked there. And the funny thing about that is that when we went, that was before the protest, right? So when you had the protest kick off, you would have generally expected that to be a super spreader event. And yet all of a sudden the data is still collapsing. And that's in line with the narrative of them lifting restrictions. So that does smell a little bit fishy. And people have speculated that you maybe can't trust this case count data as much as maybe you can in other places. I don't know what's the truth, but I find it a little bit strange that after those protests breaking out, that cases are rolling over so quickly and so dramatically. So, they're definitely shifting the narrative, and that makes me a little bit more convinced and makes me believe in the reopening story and think that in Q1, it looks like this thing is going to reopen. And so reopening type trades, like the commodities trade, do make sense. So buying dips in oil and things like that, to play a China reopening actually materializing, I think seems like a sensible trade. And things like copper as well should be well supported. Clearly, the Chinese equity market has been responding pretty well. We've been long Hong Kong calls to play that. We still have them. We rolled them to March a while back, and we've got no intention of getting rid of them, because if this thing really does go and does fully reopen and drop, the majority of restrictions, then there's a hell of a re-rating that could come in that market still. Okay, moving on. So we mentioned the oil names. So finally, we're seeing XLE, which is obviously the subsector for energy, had been outperforming the underlying oil commodity by a long way. So you saw this big divergence where that was rallying and oil was kind of going down. Finally, over the last few weeks, we've seen XLE pull back from its highs. It got as high as 95. It's trading about 85 yesterday. So that's kind of the first Fibonacci retracement level. If we look at the rally from its local low there, it's pulled back to the first retracement. It could easily have a bit more downside, but as an entry point, it's not the worst place for your first entry if you have been looking to buy this. And finally, it's giving you a pullback to maybe allow you to buy it. Why is it pulled back? You have seen refining margins in the likes of crack spreads coming down. So you can see gasoline crack spreads topped out at around 60. They're back down to between 10 and 20. And then distillates, same sort of story, peaked out higher, is much lower now, but still significantly higher than where it normally would be, where it has been in previous years. So these refiners, that their margins have come down from the highs, but they are still making money and will make money for the foreseeable future, I would think. And also, the only way these crack spreads are really going to come all the way back down is if the refining capacity responded to the fact that they're making so much money. And really, we haven't seen that, right? We haven't seen a load of new investment go into refining capacity because of the various restrictions due to ESG mandates and what the Biden administration has been pushing. So that should keep the market tight for next year. And this, I just think, is a bit of a short-term phenomenon. The energy sector has had a 50% positive performance this year. It's kind of blown every other sector out of the water. So, there may be some selling that we're seeing in the sector as a bit of position squaring going into year end. So I would have thought this thing probably is a buy the dip. Maybe it needs to dip a little bit further, but as a more medium-term view, I still like it. Okay, so how would we play it? Talking about some relative value that we're seeing between NASDAQ and DAX. So just looking here, since the end of September, there's been a clear shift higher in US index realized volatility versus European index realized. So if we were to compare, say, the NASDAQ and the DAX realized vol spread, it's kind of, since the end of September, it's always been above zero, i.e. NASDAQ realizing more, and it's reached as high as 25, and that's on a 10-day realized basis, right? So that's NASDAQ really knocking it out of the park relative to DAX, because DAX just seems a bit stuck. So I think it's because there's a keen focus right now from the US market on rates and inflation. We're obviously going to get a load of data on that next week. And then the European disaster scenario with the energy prices, etc., has kind of been averted for now. So that's what's kind of led to less realized volatility in Europe. So we think those conditions are going to persist into next week. So as a way of playing some more potential volatility next week in US markets, we think buying volatility, like short dated, maybe 1 month volatility on NASDAQ, selling the same stuff on DAX, gets you into the spread at a nice level. Now, if you were to do that as at the money options in 1 month, it would be about 7 vol points, the differential that you'd be paying. Obviously, it's realizing like 20 right now, so that's still okay. But doing it at the money is around 7 volt differential. Shift your strikes, use lower strike options, maybe the 95% puts. Then because of the differential in the skew, because DAX skew is trading expensive, that would bring that spread down to closer to 5 vol points. So if you want to do that trade on a delta hedge basis, own 1 month puts, slightly out of the money, 95% puts in NASDAQ, but delta hedge them, sell the same thing on DAX, delta hedge those, you essentially have what we call a gamma spread. You carry that gamma spread at 5 vols, and if it continues to realize 10, 20, whatever it's doing now, you should be able to make some money out of that. And a nice thing about striking it all to the downside is if we were to get a positive reaction to CPI next week, the thing would rally, NASDAQ would likely out-rally DAX by a mile, and you'll move away from all your strikes, so you won't really have much of a Vega spread to worry about, and you'll just monetize all of the money from the gamma move, and you'll be able to cash that trade in, and that will probably work quite well. And then if we were to break lower, the idea being that if we go down and we go towards your strikes, because we're breaking down through quite key levels on the S&P, for example, and we know that the NASDAQ's pretty sensitive to rates and to hawkish news flow, and the whole street is probably short gamma on the NASDAQ down there, you would expect the NASDAQ to continue moving quite violently, even if we head down. So I think there's quite a lot of outcomes where that trade can do well for you, especially over the course of the next week and a half. So we like the risk reward of that trade. All right, that's it for today. It's a bit of a longer video, but I thought that one was worth explaining in a bit more detail. All right, thanks for listening. Catch you all tomorrow.